If you've ever watched a gold chart, you already know it can be a brutally wild ride. Welcome to The Explainer. Today, we're dissecting a really fascinating evolution in the financial markets, specifically how traders are finally taming one of the most notoriously volatile assets on the planet. We're moving way past the chaos to uncover the structured, highly disciplined setups that experts use to find a true, quantifiable edge. So let's be honest with ourselves for a second. Are you tired of staring at gold, just waiting for a setup to magically appear? So many traders fall right into this exact trap. Fatigue sets in from staring at the XAUUSD chart for hours on end, and eventually manual guessing just sort of takes over. You end up forcing bad trades out of sheer boredom. But hey, that's gambling, not trading. Here's our roadmap for today. We'll tackle the setup problem, explore the dollar index strategy, dive into AI and automated bots, review the copy trading alternative, and finally, anchor it all in managing risk. All right, kicking things off with section 1, the setup problem, guessing versus edge. You know, there is a massive divide in the trading community. On one hand, you have emotional manual trading. This is where you're guessing, relying on broken setups, and forcing entries when the market is literally giving you nothing. Honestly, it's a recipe for blown accounts. But on the other hand, you have rules-based trading. This is systematic execution. It means having the psychology and patience to wait for confirmed triggers. Maybe that's a specific EMA cross, a solid VWAP bounce, or a clear rejection at a liquidity zone. And most importantly, it means executing with absolutely clear risk limits.
Moving right along to section 2, the dollar index strategy, also known as the dollar flip. To really understand this strategy, we need to look at two essential tickers. First up, DXY. This is the US dollar index, which measures the dollar's strength against major currencies. Then we have XAUUSD, which is spot gold traded against that very same dollar. If you want to accurately predict gold, you absolutely have to watch the DXY. The two are just inextricably linked. The core logic here is super fascinating. Don't just stare at gold, look at the dollar. If the dollar moves first, gold follows. Using the DXY as a leading indicator acts almost like a cheat code. By watching the dollar's momentum, you can actually spot the real institutional flow and, crucially, avoid those nasty fakeouts that constantly trap retail traders. So what is the anatomy of the dollar flip system? Well, by using the DXY as your leading indicator, you effectively filter out the bad entries. You still want to draw your clean support and resistance levels, but when a breakout aligns perfectly with a move in the DXY, you enter early with that institutional flow. And listen, you must establish strict stop-loss limits before you even click buy or sell. You aren't just guessing your risk here, it's mathematically defined using a fixed percentage risk and proper lot sizing. But here's the thing, true discipline is knowing when not to trade. You should always check the economic calendar. If there's a consumer price index data release or a Federal Reserve rate decision coming up, you skip the trade. Simple as that. These high-impact events inject massive volatility and will literally destroy perfectly good technical setups. Sitting on your hands to protect your capital during these windows is a massive part of maintaining a high win rate. Let's jump into section 3, AI and automated bots, flawless execution. The whole trading landscape is rapidly shifting right now. Traders are automating their strategies, using tools like Claude AI to write custom scripts, or building out expert advisors for MetaTrader 5. And the primary goal developers highlight isn't necessarily finding some magic formula. It's overcoming human emotion to execute setups flawlessly, 24/7, entirely without fear or greed. Think about this psychological struggle of manual trading for a second. We've all been there. You see a setup, but you freeze. Or worse, the trade goes against you and you emotionally widen your stop loss, right? Algorithms remove that entirely. They offer perfect mathematical execution with unyielding stop loss discipline. If the code says close the trade, the bot closes it. No hesitation, just pure cold execution. These algorithmic tools manage the chart step by step. Take a highly optimized script like the MST iQuank algorithm, for example. It reads a filtered dashboard to give you a precise entry signal. It instantly calculates the exact stop-loss placement and then automatically sets scaled take-profit targets, TP1, TP2, and TP3. The algorithm visually manages the entire life cycle of the trade right on your screen, keeping your messy human psychology completely out of it. All right, section 4. The copy trading alternative. If you don't want to build your own bot,
Copy trading platforms connect you directly with top-performing signal providers. You just allocate your funds, and your account automatically mirrors their exact trades in real time. It's an entirely hands-off solution. You maintain control of your balance and risk parameters, but you're outsourcing the actual execution to someone else's algorithmic or manual edge.
Finally, Section 5, managing your trading risk. Because, let's be real, no tool on earth eliminates the reality of the market.
Investors could potentially lose all or more of the original investment. That is the sobering reality of derivative products like CFDs and Forex, which is exactly how most retail traders access spot gold. Because of leverage, a tiny move against you can totally wipe out your account. Every single source we've analyzed heavily emphasizes this point. You cannot ignore it. Derivatives carry significant risk, for sure. You must only ever use personal risk capital, money you can truly afford to lose. Implement a fixed percentage risk per trade and use proper lot sizing to avoid over-leveraging, even when you have a strong setup. Remember, automated programs are support tools, not ATMs. And the golden rule of trading, past performance does not indicate future results. Just because a bot had an 80% win rate last month doesn't mean it won't crash this month. 100%. That is the exact percentage of responsibility you hold. You are 100% responsible for your own risk management and your own decision-making. Look, even if an AI executes flawlessly or you're copying a master trader, it's still your account. It's your decision on how much leverage to apply. A trading edge only works if the risk manager, which is you, survives to trade another day. To wrap up this explainer, I want to leave you with a quick question about your own trading psychology. Which part of the gold setup do you struggle with most? Entry, stop loss, or holding the trade? Identifying your absolute weakest link is the first real step to building a system that actually works for you. Keep learning, stay disciplined out there, and thanks for joining me on The Explainer.